Hey guys, welcome back to the channel and thank you so much for tuning in. In this video, I'll be explaining what index funds and exchange traded funds are, why they offer such a great investment opportunity to so many people, and how you can get started choosing an index fund or an ETF to invest in. Over the last 50 years, the stock market has returned an average gain of around 10% per year, and just $100 per month invested in the S&P 500 over this time, with dividends reinvested, would now be worth over $1.6 million. If that sounds good to you, make sure you stick around to the end of the video because I'm going to explain exactly how you can choose an index fund or an ETF to invest in so that you can take advantage of this opportunity and get your own piece of the action. We're going to get started now, but just a quick mention, I post new videos here on the channel every single week, so if you want to see new videos on all things related to personal finance, investing and entrepreneurship, go ahead and hit the subscribe button and the notification bell, and YouTube's going to let you know as and when new videos are uploaded. Please also feel free to say hello down in the comments and let me know what you think of today's video. So first things first, what is an index fund? Well, an index fund is a type of mutual fund that's designed to hold a basket of investments which match or track a given market index, such as the S&P 500. The manager of an index fund will go out and buy shares in each of the companies that make up a market index, or a representative example of them, and you and I are then able to buy shares in that index fund, which gives us exposure to all of the underlying companies. These index funds can be purchased directly from an index fund provider, such as BlackRock or Vanguard. The value of an index fund is designed to either rise or fall in line with the market index which it's tracking. And because market movements across indexes tend to be less dramatic than those some individual stocks can experience, they can be a really great way of balancing risk. Indexes have historically risen in value over time to the tune of about 10% per year without accounting for inflation, and an index fund offers a really straightforward way of participating in some of these returns. Now do keep in mind that the 10% average return is exactly that, an average. Some years the market can return a lot more than 10% and some years a lot less, but history has shown us that over time the market has returned on average around 10% per year. Now an ETF, on the other hand, is similar to a mutual fund, except that its shares are traded on an exchange, just like some individual stocks are. This means that the price of an ETF shares can rise or fall throughout a trading day as investors buy and sell those shares. This is different to an index fund, which is not traded on an exchange, and the shares in an index fund are traded just once per day after the market's closed. Just like how an index fund is a type of mutual fund that's set up to track a market index, there are ETFs that are set up to track these market indexes too. So why should you consider investing in one of these funds? First off, index funds provide investors with simple and immediate diversification. If we take an S&P 500 index fund as an example here, each share that you purchase in that index fund represents an ownership percentage in all of the underlying companies that the index fund invests in. In this case, that's literally hundreds of the finest companies across America, and this helps you to lower your risk through diversification. In addition, by investing in several index funds which track various different market indexes, you can build a tailored investment portfolio to suit your individual needs and circumstances. A common example here could be placing 60% of your portfolio into a stock index fund and 40% into a bond index fund. There are a vast number of index funds available for you to choose from. Some of these will track a particular industry, such as technology. Some will track a particular country, such as the US or the UK. And some can even track a particular style of investing, such as dividend stocks. Now, because index funds are inherently so well diversified, choosing to invest in an index fund is a lower risk option than investing in a few individual stocks. This, of course, doesn't mean that you can't lose money, but indexes are less prone to large fluctuations than most individual stocks are. And whilst it's true that the market has, in some years, produced negative returns, over the long term, the market has historically produced gains of around 10% per year. All of this means that buying and holding over the long term has proven to offset the short-term impact of any losses when the market goes through a bad year. Another reason that many investors favour index funds is because they offer really low management fees, which means that your profits aren't being eaten up to pay the manager of the fund for the privilege of investing your money with them. The cost of commissions and management fees that are charged by the fund manager, also known as expense ratios, are typically a lot lower in an index fund than they are for an actively managed fund. The main reason for this is because index funds are passively managed. So instead of having a fund manager who's actively trading stocks and a team of analysts working to give the manager recommendations on what to buy and what to sell, the manager of an index fund needs to just buy and hold investments that track the market index. An index fund will buy and hold its investments until the market index that it's tracking changes, And this doesn't happen very often. So that means there's far fewer buy and sell transactions taking place in the fund, which equates to lower transaction fees. These lower costs can make a surprisingly big difference in your total returns, especially over the long term. Speaking of long-term returns, another reason why so many investors are drawn to index funds is because they've been shown to generally outperform most actively managed mutual funds over the longer term. This strong performance record, coupled with the power of compound interest over time, makes for a very compelling investment opportunity. Whilst there are some exceptions, approximately 90% of actively managed funds have been unable to outperform the S&P 500 over the long term. In fact, one of the main reasons that index funds were created in the first place was due to the fact that most actively managed funds were unable to beat market indexes over the long term. In addition to all of this, index funds also allow investors an opportunity to easily invest their money into a wide variety of large global stocks without the need to invest in each of the underlying companies individually, which can be a very expensive and time-consuming process. There's also a highly appealing set and forget methodology in index funds, which many investors appreciate. This means that once you've chosen an index fund to invest in, there really aren't many changes that the fund manager needs to make because the underlying indexes don't change very often. So now let's talk about how you can choose a fund that's right for you. There are so many different options out there that it can be really confusing to figure out which one you want to invest in. But there are some ways that will make this a little bit easier, and I'm going to share those with you now. Firstly, you need to decide which type of investment is right for you. This means deciding whether you want to invest your money into stocks, which offer the potential of more long-term growth, or bonds, which offer more long-term stability. This will be a different decision for each of us and will depend largely on your individual circumstances. For example, a person in their 20s or 30s might choose to invest more of their money into stocks because they have time on their side to weather any short-term losses that the market can experience, and they can therefore benefit from the longer-term gain potential. Whereas somebody in their 60s perhaps might look more to invest in bonds, which will provide them with more stability as they near retirement age. Going slightly further than just stocks or bonds, you'll also want to consider whether you want to invest in a particular country or in a particular industry, or if you want to diversify even further than that into global indexes. There are indexes covering just about everything you can think of. So setting up some guidelines for yourself of the types of indexes that you want to invest in will really help you to narrow down the choices and decide where you want to put your money. Now, secondly, you'll also want to decide whether you want to invest through an index fund or through an exchange traded fund. We touched on some of the differences between index funds and ETFs earlier on in this video, but to recap, the main difference between the two is that index funds are purchased directly from the index fund provider and are traded only once per day after the markets close, whereas ETFs are traded on an exchange, just like individual stocks. The price of an ETF shares can therefore fluctuate throughout a trading day as investors buy or sell the shares. ETFs also tend to have lower operating expenses than index funds, which makes them a better option for investors who buy and hold for the long term, especially when they're purchased through a commission-free trading account. Now, the third thing you want to do is to choose an index fund that's got a track record of long-term growth. As I mentioned, there are a huge number of indexes out there. So once you've decided where you want to invest your money, it's time to start looking at the indexes that match those criteria. It's important to bear in mind that the index fund or ETF that you choose to invest in will only be able to do as well as the underlying index that it's tracking. So it's important to have a look at that index and make sure that it offers exactly what you're looking for and that it's got a good record of long-term growth. The final step is to decide on a fund that tracks the index you've chosen. Once you've decided which index you'd like to follow, there's likely to be a large number of index funds or ETFs that track that particular index. Whilst these funds will all be very similar, they will differ in the fees that they charge. So it's important to choose one that has a low expense ratio, as this will have a big impact on the value of your investment over time. In addition, some funds that are known as load funds will also charge you a sales charge or a commission for the shares that you purchase in that fund. So it's important to make sure that the fund you choose to invest in doesn't do this, and you can usually find that information out on their website. If you've made it to the end of the video, please go ahead and leave me a comment down below and also give the video a thumbs up. It only takes a couple of seconds to do, but it really helps me out and it helps the channel to grow and reach more people too. Please also go ahead and subscribe to the channel. I post new videos here every single week, so if you want to be among the first to be notified when a new video drops, make sure you hit the notification bell and YouTube is going to take care of the rest for you. Thank you so much for watching, have an amazing day, and I'll see you back here next time.